Hello guys and welcome to another video. Today we're going to talk about chart patterns. So what are chart patterns? Chart patterns are important as you will look for patterns in the direction of the trend you're trading. So if we're on a bullish trend, we'll look for patterns that make us want to buy. And if we're on a bearish trend, we'll look for patterns that want to make us sell. So they are time tested and much more profitable than technical indicators. I've already mentioned before that you shouldn't use technical indicators. Okay, they're lagging indicators. They follow price. So you'd have to wait for candlesticks to form before you can wait for an entry on a technical indicator, which usually leaves you at a much worse position than if you were to just follow the candlesticks and price action. Okay, some chart patterns work better than others because some patterns appear much less often than others. So as I've also mentioned in other videos, that harmonic patterns are much rarer than normal triangle patterns. Okay, so because of this, they're going to be more effective because they appear less often. Okay, the risk-reward potential varies on the time frame you discover the pattern on. So the risk-reward, what I mean is, so head and shoulders, for example, or any pattern that appears on the 1 minute is going to be much less effective than if you find it on the daily. If you find it on a daily chart, you'll find that you have a lot more profit potential than if you do on a 1 minute chart where the candles move much faster. Okay. So what type of patterns exist? There's many patterns, but in this video we're going to cover head and shoulders, reverse head and shoulders, triangle pattern, W pattern, and the M pattern. Okay. The head and shoulders is a great pattern to trade. It usually signals the top of trends in a bullish trend. The pattern is very simple. We need a left shoulder, a head, and a right shoulder to form consecutively to look for a short from this pattern. The next picture will explain this much clearly. So let's look at this picture. This is GBP AUD on the weekly chart. Okay, so as you can see here, I've drawn my left shoulder here. Okay, we form the head. Okay, ignore this line. This is just a trend line coming from the top. Okay, we form the head. Okay, now we have tried to form our right shoulder. Okay, so what does this mean? So then you would draw a line from here to here and wait for a break of that trend line, okay, to continue engaging in short trades all the way to the 169 potentially. Okay, so that's what the head and shoulders is. Obviously this is on a weekly and the profit potential is much higher. Okay, but you also have to be very patient with patterns on very high time frames like the weekly, because it'll take some time for it to develop, but I can assure you if your analysis is right, then the profit will be very worth it. Okay, so we can see in the above picture that the head and shoulders takes place on a weekly time frame. We can see how the left shoulder forms and rounds out. We have a breakout past the left shoulder with a clear engulfing candle, which makes the head. Okay, just going back, this is the engulfing past the left shoulder. It forms our head. We round out, okay, and we drop. Okay, we round out the top and fall past the left shoulder. Then we form a right shoulder with a retracement. The profit potential for the bottom target would be 169. Stop loss would be set above the 180 area. So this is the 180 area right here in the red. Okay, we have two doji patterns. Okay, it'd be safe to put our stop loss above here because this pattern, the right shoulder is forming. Okay, and the doji patterns are not the strongest signs of any bullish momentum that's going to go up here. Okay, so it's important to place your stop loss in the right level. So as I mentioned in the risk management video, above structure. So a good structure would be above the 180 here. Okay, so reverse head and shoulders. So it's the same pattern except they're usually seen at the bottom of bearish trends. The shoulders are rounded downwards rather than upwards. Look to trade the pattern in conjunction with support and lows on the higher time frames. Okay, the following example is on AUD CAD on the 4-hour chart. We have outlined the exact pattern with lines. So this is AUD CAD. Okay, we have a head and shoulders pattern here. So we draw our left shoulder here. We draw our head because it goes lower than the right shoulder. Okay, and here's our right shoulder. Okay, so when do we want to engage? We draw our trend line from here to here, okay, like this, and wait for a breakout. Okay, once we have the breakout of this trend line, okay, then we can enter, okay? We could place our stop loss underneath here, okay? Because this would be the proper structure, okay? And watch it fly, okay? So this line I've drawn would be your, I just drew it as the wave, okay? So this is a wave, right? I just drew it as a wave, but your profit potential, if, for example, if we were to look at this and we say, okay, stop loss is here, we want at least 1 to 1, so 1 to 1 would be here, 1 to 2 would be here, and then even more than that would be all the way up here, okay? So you could have 3 different profit targets, okay? 1 for 1, 1 for 2, and then 1 for 3, okay? So it's all based on your risk management plan and your trading plan, okay? The ascending triangle. The ascending triangle is one of many triangle patterns that you will notice while trading. They are very common but also very effective patterns when trend following. The ascending triangle forms higher lows from the bottom up and can break out. This pattern can be used in a bullish or bearish way, depends on which way the price breaks out. So here we have an ascending triangle, okay? In this case, we're forming higher lows, but we're in a bearish trend on GN. Price breaks to the low and retests the pattern structure, leaving us with a beautiful 80 pip trade on the 1 hour, okay? So what do we mean by higher lows? So here we have our ultimate low, okay? We have a higher low here. So we have a low, higher high, higher low, higher high, higher low, higher high, okay? And then we break past, okay? Why did we draw it like this? Because we're in a bearish trend. We're looking for reasons to sell, guys, okay? So 1, 2, 3. Usually the 4th strike on a trend line, okay? Usually it'll break, okay? It's very rare, okay? No, I won't say very rare, but it's uncommon for a trend line to last more than 3 tests. So you'll see 1, 2, 3, break, retest, and fly, okay? This is also proper market structure. So if we were to set our stop loss here, okay? We wait for the break and the retest, okay? Once we have the retest, okay? So in this case, we have an engulfing candle, okay? You could either place your stop loss above here, okay? But a much larger stop loss would be up here, okay? So in this picture, obviously it was much more, it was easier to put your stop loss above here, okay? So from here to here, you'd have a 1 to 1, okay? You would never hit your 1 to 2. Instead, you would hit your break-even trade, okay? Now, if you were to trade it right off the break, for example, here, then you'd put your stop loss up here, okay? And you'd have a 1 to 1 trade here too, okay? So 80 pips stop loss approximately, and you have an 80 pip take profit, okay? The ascending triangle. This pattern is like the ascending triangle, is very common and very effective in trend trading. It differs itself in the fact that we form lower highs to draw this pattern. It can be used in a bullish or bearish way depending on the side it breaks on. So this is USD CAD on the 1 hour. USD CAD was consolidating in this time, okay, in this period of time, okay? But we can see that we're forming lower highs, okay, and we formed a base here. Why? Because we hit the base once, we hit it twice, okay? We saw that price was kind of messing around here, right, until it breaks out here, okay? So just to count the amount of touches, we have 1, 2, 3, 4, 5, 6, 7. 7 touches. We finally break through, and we use the lower part of the triangle as resistance because we break and we touch, okay? And we draw our trend line from this point to this point, okay? So 1, 2, 3. Usually 3 is the strike zone in any trend line, okay? So 1, 2, strike zone. We have our resistance to confirm, and we wait for the bearish candle to form, okay? From here, we'd have a very good risk to reward ratio, okay? From here, we would like to place our stop loss above here, okay, where it's nice and safe, okay? And in this scenario, you would have hit 3 take profits, okay? W pattern. The W pattern is a bullish pattern. You'll find W's at the bottom of waves. These W's appear a lot on your chart, so you'll have to make sure you're trading with a bullish trend in order to trade these. Another way to spot W's on your charts is to look for divergence on a stochastic type indicator, which calculates momentum. So I know we said not to use any kind of technical indicators. The only time I would suggest you to use technical indicators would be to use momentum indicators to calculate divergence. Okay, divergence not a lot of people know about divergence using technical indicators. Most people would think you would sell at overbought and buy at oversold, okay? Which is why they don't work, okay? Because market makers know that people are doing this, so they just do anything to counteract that, okay? But if you were to look for divergence, okay, divergence works really well, especially on the higher time frames, okay? Because the indicators will calculate momentum. So if momentum is starting to show a bearish momentum, but price keeps going higher, that might mean that the trend is wearing out, okay? But let's go on an example, okay? So in this picture, we notice the W pattern at the low of the day at a support level. You can use a technical indicator like the stochastics and TDI to see divergence. Here's our W as outlined, okay? We have a support here, okay? These are, I know there's a lot of support and resistances here. We're going to go through them in one of the next videos, okay? But where's the divergence here? We see how this is the TDI indicator, by the way. The green is like a RSI, okay? So you can see that the RSI is starting to move up, but price is still in the same area. You see, we moved up, came back down, okay? We're in the same area. What does this mean? This means that we are divergent. So if you were to draw a trend line like this, momentum would be going up, but price is in the same area. So in confluence, okay, we have a W2, right? In this case, you want to wait for the break. You want to wait for the break of this, okay? Why? Because we can see the clear W like this. All right. Wait for the break. Okay, this is on a 15-minute. So maybe you won't wait for the retest, but just wait for the break and enter, and you'd have a really nice trade here, okay, about over 100 pips, okay? This is how we can use divergence in conjunction with W patterns, okay, to look for trades. For another example, here is an M pattern, okay, which I'll go into right after this. We can see how the RSI makes an M as well, okay, but the second head of the M is lower than the first one. But when you look at the chart, okay, look, we have an M here, but this is higher. This head is higher. So what does this mean? Momentum is shifting downwards, but price is going higher, which means that price wants to come down. Okay, this is how you can use divergence, okay, in conjunction with M and W patterns to look for trades. Now this was on a 15-minute time frame, okay, but I would definitely suggest, like I said before, the higher time frames you look for patterns, the more effective they're going to be. Okay. So the M pattern is strictly used in bearish trends. They're used to catch the top of bullish waves in order to sell them short. Just like the W's, they appear very often, so it's important to strictly trade them in a bearish trend, or if you have a good resistance on a higher time frame. You can use a stochastic type indicator which will show divergence to track and confirm these patterns. So our moving averages are below our fast moving averages are below the slow moving blue EMA, which signals a bearish trend. We get an M pattern on the resistance level and down we go. So this is GJ on the 1 hour. Okay. Now I don't have any stochastics here. Okay. But we can see divergence here. Okay. If we were to put a stochastic here, we would see that momentum would be downwards. Okay. Now, what do I mean by the fast moving averages below the slow moving average? Our big blue EMA here is our slow moving average, which means it doesn't move that much. Our teal and our white moving averages are below these two, the blue moving average. So what does this mean? This means that we're in a bearish trend. We should look for reasons to sell. Okay. Now, we want to look for multiple reasons to sell. Okay. So, for example, here we have an important resistance, 147. Okay. We have an M pattern, okay, it pins the 147 twice. We can see how this goes higher, okay, and then we have a mini M pattern here too. So we have a big M and a small M here. Wait for our engulfing candle here, okay, and we enter. Where would you want to place your stop loss here? You'd want to place your stop loss above this, okay, and you could see that all take profits would have gotten hit, okay. Now this was a violent move on GJ, which tends to happen a lot. Okay, so you have to be careful, but that's why it's important to trade with the trend. Okay, guys, thank you for listening to this video, and I'll see you in the next one.